It's becoming common knowledge that as the globe grows more ecologically conscious and green, the electric vehicle business is currently experiencing a. Analysts recommend making investments in businesses that have a future in the environmentally friendly sector. And who better to research than the auto industry? What stock, though, should you invest in, given that both established OEMs and more recent companies like Tesla and NIO are competing right now? Naturally, there is fierce rivalry, which will inevitably reward relatively early investment. Which from the companies Tesla or NIO should you buy? What growth rates are analysts predicting? To find out, keep watching the video from today. Both Tesla and NIO are automakers with the same goal of controlling the market, designing and developing electrified self-driving cars. While NIO, the Chinese electric vehicle maker, began 2021 with stock prices close to $60 per share, it has since lost more than 2/3 of its worth. In contrast, Tesla stock has lost more than 12% of its value. When is the best time to purchase the dip? Investors have had a difficult time with NIO as the company's stock price has fallen by almost 35%. NIO bears anticipate significant instability in NIO's future in 2022, while bulls in the company have viewed the sell-off as an opportunity to invest at a discount in the Chinese electric vehicle industry. Even Tesla was not safe. Similar Tesla, and Incorporated has had a difficult start to the year. As of February, stock prices for the company have dropped from $12.36 in November 2021 to $922.43 in January 2022. According to experts, these decreases have made both equities more affordable. As of February 19, NIO's stock price is $23.21, down 6.11% from its previous high. Given that the offer stocks are less expensive than Tesla's $856.98, you may be inclined to seize the opportunity. But we'll be arguing in today's video that Tesla equities are a better investment than NIO equities. Although NIO's growth seems to be happening more quickly than Tesla's, a direct comparison isn't really meaningful because of how little NIO's foundation is. Conversely, Chinese electric vehicle producers are expanding internationally more quickly than Tesla. Both Tesla and NIO are expanding their manufacturing and sales in China. It's more crucial to think about the industry's total growth than to concentrate on the company that produces the most cars. And it's highly likely that both Tesla and NIO will be successful given the size of the global electric vehicle market and the Chinese electric vehicle sector. The growth rate is an excellent measure to take into account while selecting stocks. One of the top manufacturers of electric vehicles in China, NIO Incorporated has attracted attention from investors and consumers with its distinctive battery as a service offering and powerful brand. But in comparison to Tesla, which is currently leading the worldwide EV market, it's still a little business. PEG ratios are a useful statistic to employ when comparing growth rates. However, as NIO does not yet have access to those statistics, we will be examining alternative variables. NIO's present strategy, similar to Tesla's when it was a smaller company, is to concentrate on its home market. However, the business is currently making an effort to increase its market share in foreign countries as well. On the other hand, Tesla is already well represented in the global market and is still growing, which is providing it with a competitive advantage. The corporation is currently exploring new markets like India, where government initiatives and hospitable regulatory regimes are helping the electric sector gain pace. Tesla shares have already contributed significantly to growth on a global scale, but that would make sense if NIO can match Tesla's performance. However, what are the odds of such occurring? Let's examine the figures. Since its founding in 2014, NIO has produced 3 high-end electric SUVs, the SE8, S6, and EC6, with starting prices of approximately $50,000 for each. NIO delivered about 20.5K cars in 2019, an 88 increase from the previous year, and we expect more. Comparatively speaking, though, Tesla's deliveries increased by 50 to 368K cars in 2019, and then by even more in 2020 as a result of the introduction of the Model I and the establishment of a plant in China. We anticipate that manufacturing at Tesla's new factory in Germany will start soon after regulations and certifications are granted. The Texas facility has already started production as it stands. The business plans to boost output to 2 million devices annually. NIO still has a great deal of catching up to do. In contrast, the company has a plan for the manufacturing capacity of its Shanghai plant alone. It started increasing production capacity last year with the aim of reaching 300,000 units annually and expects to debut additional goods in 2022. It's a start, even though this won't match Tesla's China production output. However, the matter of regulatory uncertainty persists with regard to Chinese stocks. Chinese and American regulators applied pressure to Chinese stocks in 2021. China's government has taken action to restrict the influence and expansion of fintech, internet, gaming, and educational businesses. Although Chinese regulators have so far spared Chinese auto stocks, foreign investors are understandably apprehensive about what the Chinese government may do next to further increase the regulatory uncertainty for NIO's investors. The Securities and Exchange Commission of the United States recently proposed a new rule that would delist any Chinese equities that did not fulfill strict new audit requirements. For Tesla, however, the situation is the exact reverse. Earlier, President Joe Biden issued an executive order that served as a catalyst for the growth of the electric vehicle market in the U.S. By 2030, the directive calls for 50 of cars sold in the U.S. to be plug-in hybrid electric and hydrogen fuel cell vehicles. To do it, the government is depending on funding and policy initiatives. It aims to raise the fuel economy requirements for major American automakers' 2026 models and has already allocated $7.05 billion for electric vehicle charging stations in the $1 trillion infrastructure plan that is presently being voted on by the House. Tesla leads the car sector in the US because it has the strongest brand recognition of any automaker. This can only mean positive things for the brand in terms of sales, increased awareness, and general expansion. In the third quarter of 2021, NIO recorded a net loss of $835.03 million, an increase over the previous quarter's $587.02 million. Bank of America has set a $66 price objective for NIO stock, which closed at $29.30 on January 9. The bank has a buy rating on the stock and projects a $2.08 billion in 2022. It will cost more for inefficient businesses like NIO to borrow the money they need to grow as interest rates climb. NIO and other unprofitable electric vehicle stocks will have to show investors that they have sustainable, lucrative business plans. To be honest, Tesla didn't always make money right away either. For the first time in its existence, Tesla turned a profit for the entire year in 2020. Prominent investors in Tesla made $721 million in net profits in 2020, with $141 going to non-controlling interest. But now that it's profitable, investors may feel more assured about the company's future prospects, and it's unquestionably a safer option. Overall, we believe NIO is a riskier gamble than Tesla, despite its recent rapid growth and creative ideas like as a battery as a service that enables users to subscribe for car batteries instead of paying for them beforehand. NIO is concentrating on the fiercely competitive hundreds-player Chinese electric vehicle market. NIO will find it challenging to swiftly increase production. It will be interesting to see if the business can increase output without sacrificing quality. It called over 5,000 vehicles last year in response to multiple fire concerns. Even if Tesla stock could seem expensive, NIO might not offer a superior margin of safety given the company's well-known and desirable brand, industry-leading innovation, unique software, and quickly increasing profitability. Tesla's business plan seems appealing, and as battery prices decrease, autonomous driving capabilities advance and could lead to software revenues and operating leverage increases, profit margins should continue to rise. And last, some investors are debating whether Tesla can survive the pressure from less expensive but just as capable rivals. This is comparable to comparing Apple to other similarly advanced mobile phone manufacturers. Even if there are now many more affordable and functional options, Apple is still important and its valuation makes sense. We think Tesla will do the same, continuing to hold its position as the industry leader in spite of the availability of other options. Which stock would you choose? Do you support Team NIO, Team Tesla, or both? Please leave a comment below.